This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jonathan Farrow and Lisa Abramowitz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. With us, Seth Carpenter, the Chief Global Economist at Morgan Stanley. Is this just about an R start? Are we all John Williams this morning and we're readjusting? I had Clarida with me last week at a Bloomberg event. 2.0% is not 2.6%. I mean, are we really talking, as Mike alludes to there, about a new inflation regime?
I think you want to separate out a couple things. One is the new inflation regime. And there, if you're comparing it to where we were from the financial crisis through COVID, I think you have to say yes, right? The Fed was consistently missing its inflation target to the downside by, call it, a 0.25 percentage point. We're clearly above target now. And over the next several years, they want to bring it down. But I'm not sure they want to go back to the old days of, being below 2% on a regular basis. So if they're going to be averaging a little higher during expansions, call it a tenth or two above, you're talking about 25 to 50 basis points higher inflation, so that's got to be there. I don't think we're talking about the difference between 2% inflation and 3% inflation.
I want to tell you on radio and television where we're heading here. What a half hour we have. We have Dr. Carpenter with us on the broader economics of this moment. Ira Jersey scheduled to join us, just exquisite here on fixed income dynamics. And then we do even better. Mark Cabana is going to darken the door, who's just expert on your world about, the different tranches of the auctions.
I want to dig into what the implications are of this announcement, Seth. And to me, I'm looking at the idea that they're really going to force the front end to do a lot of the heavy lifting here. Does that pose a greater risk than people realize?
So my view is no. The way I would think about it, there was a speculation that back and forth a little bit earlier, did the Treasury just react to the market? And I think you want to remember that the folks there at Treasury, Josh Frost, the Assistant Secretary, the career staff in debt management, they have a structure now. They have a framework for how to think about what to issue, and they're looking at what is the market saying about where the market wants to pay up and where the market's demanding a discount. And at the margin, they'll lean a little bit more to where the market wants the paper and lean a little bit away from the place where the market's pulling back. And we've seen over the past several months a big sell-off in the long end. It showed up, in model speak in the term premium. And they're paying attention to that. It's not that 1 week to the next or 1 month to the next or even 1 quarter to the next. Is it sustained?
Well, what we are seeing is very much a strong move on the long end, and that 30-year yield plunging back below 5%, as we were talking about. Do you think that this indicates that really what we're seeing in yields is entirely a supply-driven story more than anything in terms of an economic read on strength and inflation in the U.S.?
So, no, it's so hard to pin it on any single thing. When I talk to our clients here in New York, in London, around the world who are trading in treasuries, there are a whole set of different narratives, one of which has been supply. People have been worrying about the deficit, which is exactly why Secretary Yellen came out and said it's not the deficit. People are worrying about stronger growth. Q3 GDP data was very strong. There's no two ways about it, and so that contributed to it. Other people are worrying about, is there going to be a pullback from risk by global investors? Other people are looking at the Bank of Japan. We just had that meeting, right, where they effectively de facto got rid of yield curve control. So it's not just one single thing. It's everything coming together.
So what's your compass at a time where we're expecting the Fed to come out today at 2 in varying shades of we have no idea and we will see just along with you? What is your guiding lodestar?
So we're trying to figure out, along with the Fed, sort of what's going on with the economy. The strong Q3 data notwithstanding, there are some signs of the economy slowing down. The last jobs report, super strong, but if you look at the trend over the past 18 months, clear downward trend. If you look at the GDP data, consumption spending holding in, but a lot of the strength was in inventories. CapEx was, not very strong at all. And so we are seeing that slowing. And so what we think is the Fed's looking at the same data we are. They're driving by feel a little bit, and they're not going to hike today. We don't think they're going to hike in December because inflation just keeps undershooting their own forecast for where they thought inflation was going to be this year.
What does the job dynamic look like with an Ellen Zentner sub 1% Q4 GDP?
Well, I think this is where we want to keep in mind that there's so many swings from one quarter to the next to some of the spending data. Like I said, the inventories numbers, that was never going to be the primary driver.
So she's not giving you gloom on the job economy here.
Not at all. I will say that we have at Morgan Stanley, Ellen and I and the rest of the team have been consistent from the beginning of this hiking cycle to say, the Fed's going to hike, they're going to bring down inflation, but we are not going into recession. It is not doom and gloom.
Well, she's expert on the American consumer. What is Zentner, when she gets fired up, you know she does, when Zentner gets fired up about the American consumer, what is she saying?
Lots of things, but in particular, one of the key risks that maybe people are overlooking for why there should be a slowdown in the fourth quarter is student loans, right? There was a moratorium on student loans. That's been lifted. We're starting to see that payback starting to happen, and that has to crimp consumer disposable income, so that matters. Durable goods, right? Interest rates are high. Credit card rates are high. People financing cars and other things, it's just costing more, and so they'll pull back on the spending.
All right, just extraordinary. Seth Carpenter, thank you so much. Really, really appreciate it with Morgan Stanley. He writes piercing notes for Bank of America. There's no other way to put it. Head of U.S. rate strategy. He's aged in the last 10 minutes. Mark Cabana joins us this morning. So I'm like refunding. So what? I don't care. Everybody's in a lather. It comes out. And to me, it was sort of, I really don't care. Janet Yellen said, we're going to do short paper. Yeah, we're going to do long paper. But we're the United States. Our listeners, our viewers who are not sophisticated, do they need to fear the fiscal system of America?
No, you shouldn't fear the fiscal system because the U.S. economy is still going to be very robust. There will be buyers for Treasury paper. It's just a matter of at what level will they step in. And we've had a relative lack of buying recently, but that's meant that yields have had to adjust. And as they've adjusted, that should incentivize more investors to think about owning bonds. And we do think that rates are going to keep rising or they're going to stay elevated really until you see one of two things. Number one, until you see the macro data slow. We don't think that you've really seen that yet. Or two, until you see de-risking, until you see investors who think, you know what, rates are kind of high. Real yields, almost at 2.5% at the 10-year point. That's a decent own, and maybe I should think about de-risking in my portfolio.
This is such a valuable conversation, and I got to get to what we see on balance sheets right now, mark to market, and the rest of it in bonds. But let's stay on this theme right now of our new higher yield regime. How far out are you in the longer? I mean, if you take any given yield, any given spread, is there a Cabana 1 year? Is it a Cabana 3 years? How do you see the regime of longer?
Well, we just think that rates are going to have to stay higher for longer, not to reiterate the Fed mantra, but we really believe it because we've seen an economy that's been so resilient in the face of relatively elevated interest rates. And as long as that happens, that just is going to mean that the Fed doesn't have to cut for a while. Now, when I think about longer, I personally think about 5 years plus.
Oh, wow. Okay. You got my attention.
Just because, most investors who really focus on liquidity and liquidity management, they think generally 2 years, 3 years. But when I think about intermediate to long end, I think about 5 years plus.
Okay, and I'm going to invent this phrase right now. I haven't seen it anywhere else. I want copyright on this if you use it. Is it normal for longer? Is that really what we're talking about? Is we're back to a normal rate regime?
Well, it's certainly we're back to a regime that looks a lot more similar to the pre-financial crisis than the post-financial crisis.
And you got a 5-year window on that. So what maturity do you buy? I'm in cash. I'm really comfortable at Bank of America. What maturity do you buy given a 5-year normal for longer view?
Well, it really depends upon what your overall investment horizon is and where your preferences are. We think that if you're focused at the front end, you probably want to be neutral to slightly overweight your benchmark. And if you're a more long-term investor, we think that you at best want to be neutral right now. And you want to stay neutral until you see those signs of feedback that tell you that higher interest rates are finally slowing the economy. Not just one data point here or there, but in the tier one stuff, in labor, more clearly in inflation. You want to stay neutral until you see those signs or until you believe that there's a clearer and more definitive negative feedback from risk assets, which I don't think that we have really seen sufficiently yet.
I love to bust Brian Moynihan's chops because he like no other CEO quotes his research staff. And I'll go blah, blah, blah about bonds. He goes, well, Cabana says. So let's get the report from Cabana that you would give to Brian Moynihan right now. I got balance sheets nationwide mark to market, I get. And I got everything else with massive bond losses, price down, yield up. Should our listeners and viewers be afraid of this non-mark-to-market garbage on balance sheets?
Well, I think you're talking about bank balance sheets, and we do appreciate that Brian reads our research. He's a staunch supporter, and we really do appreciate that. We think that what banks are doing right now is that they are really prizing liquidity. They really want to hold as much liquidity as possible. They're choosing to hold cash. They're keeping reserves with the Fed, and they're not buying bonds, they're not buying treasuries or mortgages, and they're prizing liquidity because they know that they need to meet their outflow needs. They know that their securities book is not particularly liquid because it's so low in value. You don't want to sell and realize the loss. We saw what happened with some of the regional banks.
So what do you do? This is the key.
So what do you do if you're a bank?
What do you do if you're a bank, if you've got all this out there and you don't want to sell, just like you said, but things can happen, things can change? How do you process that reality?
If you're a bank, what you're doing right now is you're holding cash. That is the game. That's why the Fed shrunk their balance sheet through QT by $1 trillion, and you've seen bank cash holdings not move down very much at all. They are bidding up on the liability side of the balance sheet. They're issuing CDs, time deposits, et cetera, to take in more money because they're seeing retail outflows, and then they're holding cash. And they're going to continue to do that until they see signs that the economy is turning, until they know that their loan growth is really slowed down and maybe negative on a year-over-year, 6-month average or whatnot. And they're going to wait until the economy slows more meaningfully to extend out the curve and buy those bonds. Right now, banks are not buying duration. They've been shrinking their Treasury and agency holdings, and they're going to wait to add duration until they see definitive signs that the economy has turned. And so, again, what banks are doing right now, it's holding that liquidity because that is the most valuable thing that they seem to believe that
What does holding out liquidity mean for mere mortals that can't hold out liquidity? Small business, Torsten Slok at Apollo talks about 10% small business loans as well. I saw a 31% charge card the other day. It wasn't Bank of America, of course. 31% charge card interest rate the other day. What does the public do? Given price down, yield up, banks saying, I'm scared stiff, I got to hold cash.
Look, it's a tough time to be a borrower. I think we know that, right? It's a tough time to move. It's a tough time to buy a home. It's a tough time to be a business if you need a loan. And that's exactly what monetary policy is trying to do, right? It's trying to slow down activity by reducing demand for loans and borrowing. And so if you're a small business and you do need a loan, well, you need to think about, okay, what other liquidity sources do I have? Can I draw on any other type of liquidity? And then you got to ask yourself, do I really need to expand? Do I need to make that next investment? And you got to make sure that you can clear a much higher hurdle rate in order to justify those costs. That's how monetary policy works. It should slow down activity through the lending channel. And to some extent, we're seeing that. But it hasn't happened, I think, to the extent that the Fed would like.
Mark Cabana, thank you so much for the Bank of America. Joining us now to begin strong on this day of a Federal Reserve meeting is Dominic Konstam. He's head of macro strategy at Mizuho Americas for years, literally iconic at Credit Suisse. We're thrilled that Dr. Konstam could join us today. Dominic, I give you the phrase super restrictive. Is Jerome Powell's Fed combined with market action a super restrictive Fed?
Well, yeah, in the context of the sustainability of the U.S. consumer, and if you like, the overhang of debt refinancing in the corporate sector really beginning in 2025, clearly the front end is super restrictive and is going to have to get reversed quite aggressively at some stage. The issue is the timing, and that timing has been pushed out because the consumer, who's got great balance sheet, has decided that even as they spent all their fiscal excess that they were given after COVID, they're deciding to leverage up even with interest rates as high as they are. But they can do that because of the balance sheet. So that kind of delays the impact of this super restrictiveness, which is kind of a bit of a conundrum for the Fed.
So that's the price for longer, not higher for longer, but just longer. What is the cost to Jerome Powell of a longer strategy at these levels?
Well, I think what's happened in the last couple of months really has been that the Fed has decided that, because effectively they are super restrictive, they didn't want to, keep on pushing up short rates. They don't want to quickly go to 6%. So they've emphasized this idea that they're just going to hold at a high level for that much longer. But ironically, that directly feeds into a sell-off in the back end. The idea that what we call term premium, this risk premium that's short rates end up being higher than the equivalent tenor of a longer dated treasury. That's term premium. That gets priced into the market, which is why you've had this enormous sort of bear steepening going on with 10s going up to close to 5%, 30s, 5.25%, etc. And in a way, that's not a bad thing if you want to slow the economy, because that will undermine and is undermining risk assets, and it will help to tighten financial conditions overall. So that's the impact of what the Fed is doing. There is a risk, though, that they run, because you get people concerned about as you mentioned earlier, the refinancing of the Treasury. When they decide to issue longer dated debt, that now is coming in at much higher interest rates. And you start worrying about a vicious circle where if you can't reduce the deficit through spending cuts, well, you've got another problem because your interest service costs are going up at the same time. And that's kind of get people worried about this idea that Treasury isn't going to be able to sustainably fund itself down the road, particularly when you get those sort of bigger issues coming up, the structural issues coming up that will mean higher deficits.
There's always been a sort of uncomfortable tension, especially now, between the Treasury Department and the Federal Reserve, especially because the Treasury Department is helmed by the one and only Janet Yellen, who used to head the Fed. How much is the Treasury going to try to game out the market and kind of give a helping hand to the Fed by not concentrating some of those debt sales in the longer end, sell T-bills and hold pat and wait for things to normalize?
Well, I mean, it's obviously a great question and issue. I mean, strictly speaking, I don't think Treasury really should game things too much. They're not really traders as such, and if they were, then maybe God help us. I mean, the idea I think is you do have rollover risk. So no one really knows how quickly long-term rates might reverse, even if we go into some slowing. Where is this sort of neutral rate? It might be higher, and maybe 10 years trading around 5% is the sort of new norm. So I think it wouldn't be appropriate for the Treasury to really try and game the market sort of near term and sort of second guess that short-term rates are going to come crashing down and they'll be able to refinance themselves down the road by extending maturity later. So I think they'll probably extend the duration. I think the estimates are kind of, seem about right, this sort of 114 billion and putting it in coupons. And because of the announcement we had earlier in the week, they can cut bill supply a bit. So that's our expectation, and no gaming of it, basically.
A lot of people expect this to be a boring meeting. Subhadra Rajappa calling it a placeholder. Steve Englander saying, how many ways can you say, we'll see? I mean, this is basically going to be a holding kind of pattern. And yet we see a dissonance growing where the market sees an escalating chance of reaccelerating inflation at the same time that the Fed's kind of seeming to subtly agree with Janet Yellen, saying that yields are going to go back down. Do you think they're going to bridge that gap today?
Well, they could do. I mean, they've always got the option to. I mean, there are a couple of interesting things going on. I mean, obviously, the sell-off in the long end is very interesting, and I think they can definitely address that in the conference call and basically say that's doing some of the work for them and be a bit more optimistic. They can also be actually, even though inflation has been a bit sticky on the very latest prints, they could be a bit more optimistic on that. We've done some background analysis on that, and the reason why inflation has been a bit sticky is it's really been on the demand side, less on the supply side type thing. And I think that's encouraging because that's something a little bit more understandable and sort of indicative that, the underlying trend lower is still in place for inflation. And obviously the global inflation picture has been looking a bit better. So I think they can basically, I don't think it'll be an uninteresting meeting or press conference. It's just really a question of how far Powell wants to go down the road and try and sort of reassure markets. One interesting thing I always think is that, to what extent did the Fed really anticipate or understand that their actions at the September meeting was going to lead to this sort of, near 100 basis point sell-off in the long end? I mean, it's been quite dramatic. And did they really expect that, I guess is the question.
Dominic, I want you, this is outside your remit, but we've known each other for years, so I'm going to go from the macro of Constum to commercial banking. Bernanke taught us at Princeton that financial structure and strength matters. I'm looking at the technical construct of the American banking system, and I don't like what I see. Should the Fed fold in what's happening to the banks right now? Should they today pay attention in their meetings to the weakness that we see in commercial banking equity prices?
Absolutely. And I think the thing that so many people miss is they think that banks are kind of less important now than they were before because of alternative banking, fintech, private equity, other forms of leverage, if you like, in the system that people seem to think, credit is created elsewhere. Credit is that there's something called outside money, which is a central bank, and they start the credit creation process. There's then something called inside money, which is the banking system, and they continue the credit creation process. And to be honest, that pretty much is how credit is created. Money can only be created by the Fed and the banks through the bank multiplier. It cannot be created by private equity. They have to get their leverage from somewhere. And so I think you always have to go to the banking system, and you always have to focus on if the banks are kind of doing their job, even if the leverage overall in the system is getting higher and higher, and relative to the banks, they're the ultimate ones who if they pull the plug, let alone the Fed putting the plug, then the whole kind of system can start to implode. So I do think it's very important what's happening in the banks. And I think it's a big concern that obviously lending is slowing down. There is obviously regulation, and there's some credit, some capital restrictions taking place, but that's all part of the cycle. And as long as the Fed is there to pick up the pieces at the end of it, then we're fine. But those pieces will need to be picked up.
You sound like Alan Meltzer, the late, great Alan Meltzer, lender of last resort. Dom, I got 30 seconds. Are you concerned at the massive shift from deposits to money market funds? Is that going to destabilize the system?
Well, it's been a challenge, but to be fair, the TGA build-up that the Treasury has done has actually come at the expense of a lot of the money market funds and the repo there. So I think the Fed has actually managed this process relatively well with the help of the Treasury rebuilding TGA with all that bill issuance. So it's a relatively orderly process, but it's obviously something that you've got to keep watching. You don't want excess reserves to get too low in the banking system.
Dr. Kostom, thank you so much. Dominic Kostom with us with Mizuho today. Just a terrific brief there. Joining us, Dr. Win Thin, Global Head of Currency Strategy at Brown Brothers Harriman. Win Thin, you were at the altar of Robert Mundell at Columbia, who invented our international currency dynamics. Is there a theory to what Japan is doing, or are they making up original theory?
Well, first of all, thanks. As always, a pleasure to appear here with you guys. To me, it's an experiment. It's an ongoing experiment. Japan has been fighting deflation for decades, and they've thrown everything at the wall to see what sticks. The latest iteration was negative rates and yield curve control. And by hook or by crook, it's finally getting out of deflation. It's obviously the policymakers are very nervous. They're starting these policies is the easy part. Getting out of them is always the hard part. We saw the Fed struggle with getting out of QE back after the great financial crisis. So what we've been seeing unfold really over the last year is just a really haphazard sort of, again, throwing stuff at the wall to see what works. It's been, again, more out of fear and concern than anything else. They don't want to upset the apple cart. The recovery is by many measures, quite modest and vulnerable. And so that's what we're seeing. I do think that Japan will exit accommodations fully in early 2024, and by that I mean a rate hike.
Why should our viewers and listeners care in the Western world? It just seems to be removed and over there. For example, comparing the yuan, the renminbi in China to Japanese yen, even with weak yuan versus the dollar, it's stunning how weak the Japanese yen is versus renminbi. Why do I care in America?
Well, I think as you guys pointed out just earlier in the segment, Japanese investors have been basically leaving Japan and chasing yield and returns elsewhere. And that's because of the zero rate interest policy and yield control. Domestic yields aren't attractive enough. So we've seen massive capital outflows from Japan over the last years, if not decades. If we get to that inflection point where things change and actually rates are allowed to sort of go back to market-based levels, I think the fear, at least in Japan and others, is that that wave of capital will come crashing back. We've already seen announcements from some of the Japanese life insurers that they plan in the second half of this fiscal year to underweight foreign investments, foreign bonds, and overweight JGBs in anticipation of normalization. So there's all sorts of capital flow stories that I think, coming at a time when we don't know what the Fed's doing, we don't know what's going on in Europe with the Middle East. It's just another sort of added uncertainty that markets have to digest. And I think that's what I think investors in general are worried about.
It's almost deliberate ambiguity. Is deliberate ambiguity by the Bank of Japan going to actually create some sort of soft, gradual increase in yields and some sort of controlled departure from yield curve control?
Yeah, at least I think that's what we're seeing. I mean, in fact, in my opinion, the yield curve control is dead. It's deader than Elvis right now. As far as I can tell, they've introduced this ambiguity where it's now 1% is now a reference point. Well, who knows what that means? So the market will prod and test the Bank of Japan, not just on yields, but also on the dollar yen. And it's going to be a cat and mouse game. But really, for all intents and purposes, JGB yields are going up. They have been going up. They will continue to go up. We'll go above that 1% sort of reference point within days. And the upside, I think maybe 125, 150 is sort of a natural sort of target for the markets. Where we go from there will depend on what's going on in other global markets, especially U.S. Treasuries. But again, this is normal. This is, it's very, what I would say, an abnormal period. And it's been going on for decades in Japan of zero rates, negative rates, yield curve control, and it's abnormal. And I think that they're trying to exit that, but are obviously very, very scared of the ramifications.
Lisa, moments ago, the DXY unraveling right now, 106.91. We're really buttressed up here against a 107 on DXY, and it's clearly led by yen dynamics. And this goes like the banking stocks. I'm sorry, you just have to look at the Bloomberg screen, and it's screaming a certain level of tension out there this morning without being, a toxic brew of gloom. I mean, it's just the markets are speaking before this Fed meeting, and it's not all the managed message of the elites.
When, to that point, how disruptive is the fact that the dollar has continued to strengthen and not weaken as so many people thought this year?
Well, for the U.S., it's good because a stronger currency helps to limit imported inflation. What we're seeing particularly stressed is in emerging markets, especially in Asia, that's being double whammied by the yen and by the dollar. But basically, we've seen many emerging market central banks intervene to help support their own currencies. We've seen surprise rate hikes. We saw that from Indonesia last month. And we've also seen countries that are cutting rates slow their easing because the currencies are coming under pressure. So to me, it's really a toxic brew for emerging markets. That is tight monetary conditions in the U.S., slowing global growth, slowing China, and easing cycles in emerging markets. And that's all, to me, a very toxic brew for emerging market currencies.
You should have seen Tom Keene's face when you said toxic brew. His ears perked up and he was fully engaged.
That's what Robert Mundell used to say. Robert Mundell would be in a lecture and he'd say, look, the Mundell triangulation, and particularly on unified currency, it's one big toxic brew.
This is a difficult time because people have been throwing around words like toxic brew for quite a while. And yet we have been in a sort of uneasy equilibrium all year that's really been capped off by U.S. dynamism. You go, what do you mean, Tom?
I don't think it's been an uneasy equilibrium. I think the markets are talking here. I'm going back and forth with Doug Cass here on the banks. You can rationalize this all you want. Yen 150 was why we're talking to Win Thin.
So Win, weigh in on that. Are things breaking down in a more material way that'll lead to more dramatic moves in FX?
Well, I think the main driver that's really, I think, taken everyone by surprise is just the continued strength of the U.S. economy. And by that extension, the U.S. dollar, the Fed, and all that. I'm of the opinion that the Fed will probably get us into a recession next year, but I don't look for anything, quote unquote, break. By break, we mean like a financial crisis, a banking crisis of some sort. We had a scare back in March with SVB, but we found that was, to me, an idiosyncratic situation with SVB and Signature. So to me, all the stress tests suggest that the global financial system remains fairly resilient. Now, look, we all know that doesn't mean a whole lot when push comes to shove. But I do think that we are sort of in this post-Great financial crisis situation where, yes, the institutions and overseers and regulators are all sort of on the same page and hopefully willing and able to head off a crisis. Now, we'll see pockets of stress. We've had frontier markets blowing up. emerging markets will continue to remain under stress. Look, UK, Europe are into recession, but nothing sort of broken. This is sort of a normal thing. I guess I'll leave this, with the final thought is that it's a normal sort of situation in terms of downturn.
Okay.
We're going too fast here in the U.S. Fed's hiking. We're going to slow. We maybe go into recession, but then the whole cycle starts over again. It's not something to worry about.
Got to leave it there. Dr. Thin, thank you so much. He's with Brown Brothers Harriman.
There's been an issue in the U.S. side of things. First of all, how deeply the U.S. troops will get involved, but also how much aid can actually get passed to go towards supporting both Israel and Ukraine, which no one is talking about. Jennifer Flitton covering all of this. Fantastic guest to really analyze it for us. Head of U.S. Government Affairs at Invesco. Jennifer, what do you make of the split that we've seen with the House proposing a separate bill to fund Israel that yesterday President Biden said he'd veto?
Right. He issued a veto threat. That's correct. Yesterday, we're going to see what the House can do. I think it's still an open question if they have the support, because they have paired the Israeli funding with an offset that directly sort of impacts that Inflation Reduction Act and the expansion of the IRS. And so they will lose the vast majority of Democrats. Could they gain a couple while they lose a few of their own Republicans? I think that's the question. And we'll see that play out on Thursday.
What does it tell you about the nature of funding agreements if funding Israel comes at the expense of cutting the agency served with collecting taxes?
Well, first, I would say this is an opening salvo for the House, because they will have to negotiate no matter what with the Senate. Schumer, the majority leader in the Senate, has already stated that this is dead on arrival. So there is an expectation that there will be further negotiation. But when it comes to offsets, this is a reflection of what is happening in America right now with regard to our own domestic debt, our own deficits that we're running right now. And that's what Republicans in their districts really feel a need to answer to.
Jennifer, I believe it is November 1st. Count it down, 16 days to November 17th. It's been left in the debris. We've forgotten about November 17th. Give us a brief on the importance of November 17th inside the Beltway.
It is coming upon us very quickly. That is an excellent point. And it is not lost on most members. Also, most members that want to get Ukraine funding through the House, Republican and Democratic members. And the continuing resolution, which is that stopgap that runs out on November 17th, that has to be extended. The Ukraine funding may have to ride on that continuing resolution, however they work it out. And we'll see that over the next week. They're currently drafting another continuing resolution in the House.
Jennifer, there's a real dissonance in the headlines that I've been reading, and I am trying to square them. I'd love your help. Basically, on one side, you see the fight that's escalating in Congress. It's escalating with the White House over how to get financing to back these efforts. And then on the other hand, we're talking about U.S. troops potentially being in Gaza indefinitely after the war to keep some sort of peace. What is the appetite in the United States to have a protracted role in some of these conflicts that seem pretty intractable right now?
That's right. I think there are a number of steps, though, that we have to get to first, right? Because U.S. troops are in the region, of course. They are in Iraq. They're in Yemen. This was discussed a little bit at the hearing yesterday with Secretary Blinken and Secretary of Defense Austin. They have been attacked over the last week, 2 weeks. They have had to retaliate in those attacks, and the expectation is to deter further escalation. That, I think, is the immediate issue before we get to the longer term issues in Gaza after Israel is able to contain that area.
There's also a really short-term kind of issue with respect to President Biden's approval rating in some of the swing states. And there was a poll that recently came out that more than 50% of Muslim Americans used to support President Biden, and now fewer than 20% currently do. How significantly is this going to color the entire debate next year?
That's an excellent point. I think the tension there within the Democratic Party and seeing some of those polls, but even seeing the streets, right? I mean, we've seen the protests across America, not just among Arab and Muslim Americans, but also with young people, young progressives on college campuses. And they do see that as a threat. So how they're going to diplomatically work within their own party and their own voters,
right.
I think we're starting to see that play out.
Jennifer, thank you so much. Jennifer Flinton with us with Invesco there on Washington and the war in the Eastern Mediterranean. Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.